Welcome to today's deep dive. We are looking at a stack of market bulletins and analyses covering the gold and silver markets, and this is specifically as of the evening of June 16th, 2026.
Yeah, and it's quite the stack of data today.
It really is. And, usually when we look at financial markets, the mechanics of cause and effect make a lot of sense. Like a company announces record profits, its stock price shoots up.
Right, exactly.
Or a major crop fails due to weather, the price of wheat skyrockets. It feels logical. But every now and then, you look at the global markets and it feels like you're staring at this massive, incredibly complex machine that has suddenly and inexplicably just paused.
It's completely frozen up. Yeah. You're looking at all the gears, you know they should be turning, but nothing is moving. And to help us unpack this, we have senior market analyst Michael Anderson here to connect the dots between all this raw data and, well, what it actually means for your portfolio. Because there is a glaring contradiction staring right at us today.
There really is. I mean, it's a very tense environment.
Right, because gold is sitting at these historic, dizzying highs, the kind of numbers that usually trigger an absolute frenzy. Yet, the smart money, the institutional investors, the hedge funds, they seem completely paralyzed. So our mission today is to figure out exactly what the market is waiting for and decipher the hidden signals here.
Yeah, to understand that freeze, we really have to look at the immediate pressure in the market. Because right now, gold is locked in this intense tug of war.
A massive tug of war.
Exactly. As of the evening of June 16th, it's hovering right around $4,330 per ounce.
Which is up, what, about $30 from the previous night?
Yeah, about $30. But the critical detail isn't just the price. It's the incredibly tight corridor that it's trapped in. I mean, it is aggressively bouncing back and forth between $4,315 due and $4,355.
And when you look at the trading volume, it's like every single time gold tries to push higher, the second it crosses that $4,355 mark, short-term selling pressure just instantly kicks in.
It knocks it right back down.
Right. Those large cash flows just haven't returned to the table to sustain a real breakout.
Well, because they refuse to move. They're waiting until they get a signal from the U.S. Federal Reserve. The entire global market is basically stuck in this waiting for the Fed mode.
Yeah, nobody wants to make a move.
Because institutional investors, they hate uncertainty. They'll happily trade in a terrible economy or a booming economy, but they will not trade in an uncertain one.
But okay, let me push back on that for a second. It's like a runner on the starting block waiting for the pistol, right?
Yeah.
But if you look at the consensus, investors already know the Fed is going to pause interest rates at this current meeting. It's completely priced in.
It is priced in, yeah.
So if everyone knows the outcome is a foregone conclusion, why is the market still frozen? I mean, shouldn't that certainty trigger some kind of reaction?
You would think so, but the market doesn't actually care about the present. When analysts say the market is a forward-looking mechanism, they mean it's a giant prediction engine. The decision to pause rates today is already old news.
Ah, so they're already past it.
Exactly. The big money adjusted their portfolios for that a month ago. What they are desperately waiting to parse is the FED's commentary about the future. They want the forecast for the coming months.
Okay, so it's not the action itself, it's the press conference after the action.
Precisely. They're looking for the internal stance on inflation. Any hints about when future rate cuts might actually happen.
Right, because that dictates everything.
It all comes down to currency strength and bond yields. The market wants to know if the FED is leaning dovish or hawkish.
And if they're dovish, meaning they hint inflation is under control and cuts are coming forward. The U.S. dollar, which is sitting slightly weak right now, around 99.5 points, that drops further, right?
Yes, the dollar drops and yields drop. And that boosts gold. But if the Fed takes a hawkish stance, if they step up and say, hey, we aren't cutting rates anytime soon, inflation is still a threat, then the dollar strengthens.
Yields stay high.
And gold faces massive profit-taking. Investors will just pull their money out and put it into high-yielding cash.
Wow. Okay, so while gold is completely paralyzed, waiting on the edge of its seat, if you look next door at silver, it's a slightly different story.
That's a very different story right now.
Yeah, because silver is holding its ground much better. It's hovering stably right around $70 per ounce, just oscillating between $69 and $71.
And that's because silver operates on a different fundamental logic. It has this dual identity.
Right.
Gold is almost exclusively a monetary asset, a psychological safe haven. But silver, while it is a safe haven, it's heavily used in industrial applications.
We're talking solar panel production, complex electronics, electric vehicles.
Exactly. So it has a physical utility floor. Even if people aren't buying it to hide from inflation, manufacturers still have to buy it to keep their assembly lines running.
So it's benefiting from both the safe haven status and the expectations of high industrial demand.
Yeah, which makes it a much more balanced asset right now compared to gold. But if we pull back to gold and this obsession with what the FED thinks about inflation, we have to look at the biggest driver of that inflation.
Which is oil. And the underlying mechanics of the oil market right now are just fascinating, especially regarding how they impact gold.
They really are.
Because we are seeing oil prices cooling off significantly after all that intense Middle East heat. WTI crude is down to $77.37 a barrel, and Brent is down to $80.93.
And the assumption driving that drop is heavily tied to geopolitics. The sources are indicating the market is pricing in a very high probability of a U.S.-Iran agreement.
And just to be super clear for you listening, as we analyze these sources, we're looking at this U.S.-Iran agreement purely as an economic assumption. We aren't taking any political stance here. We're just reporting what the financial models are assuming.
Right, absolutely. The market assumes this agreement would gradually reopen and stabilize the Strait of Hormuz.
Which is a huge global choke point. So if that stabilizes, the risk premium vanishes and oil comes down. But let's look at how this physically impacts things, because this creates a bizarre seesaw effect on gold.
The dual action effect, yeah.
Yeah, on one side of the seesaw, oil gets cheaper. That means inflation goes down. Lower inflation means less pressure on the Fed to keep rates high, and lower rates are great for gold.
That's the positive side. But on the other side of the seesaw, if inflation goes down, doesn't gold lose its main superpower?
Right. I mean, why buy gold if you weren't terrified of your money losing its purchasing power?
That is the exact paradox. Retail investors view gold as an inflation hedge, but institutional money manages gold based on real interest rates.
Okay, let's break that down practically.
Sure. A real interest rate is just the baseline interest rate minus inflation. So think about it like this. If the bank pays you 5% interest, but inflation is at 4%, your real return is only 1%.
Right. So holding gold makes sense there to protect your money.
Exactly. But if oil drops and drags inflation down to, say, 2%, while the FED keeps rates at 5%, suddenly your real return on cash is a very healthy 3%.
Ah, and gold pays absolutely zero interest. It just sits there.
It just sits in a vault, and it actually costs you money to store it. So why hold a gold bar when you can sit on pure cash and earn a high yield? That's why gold is stuck at $4,330. The two forces of the oil seesaw are basically canceling each other out.
It's a complete structural stalemate. And realizing that really forces us to challenge one of the oldest myths in investing, the whole war equals gold goes up idea.
Oh, the sources explicitly warn against that simplistic idea.
Yeah, people think geopolitical tension is rising, I need to blindly buy gold, but the real driver is global cash flow. The market doesn't care about the news, it cares about where the big money decides to go.
Cash flow is like water. It just follows the path of least resistance toward the highest yield.
And right now, the big money has competing options. If instability fades and the economy improves, cash is going to flow into stocks. Plus, the US dollar and bond yields are still high enough to be very attractive.
They're huge competitors to gold right now.
But wait, let me push back on that. If stocks are looking attractive and bond yields are high, why isn't the smart money dumping gold entirely? Why are we maintaining this massive $4,300 level?
It seems like it should crash, right?
Yeah, why isn't it crashing?
The answer is central banks.
The sovereign entities themselves.
Yes. Retail investors and hedge funds might trade based on quarterly yields, but central banks are playing a multi-decade game. The baseline support preventing a crash right now comes directly from them.
Because they are maintaining a historically high demand for physical gold reserves.
They are aggressively buying and hoarding it, and more importantly, they are not selling.
So they aren't treating it like a short-term trade at all. They are basically pouring a concrete foundation under the market.
That is a perfect way to visualize it. When a central bank buys 50 tons of gold, it goes into a vault and disappears from the open market. They're absorbing the excess supply.
Which creates a hard floor. They're the ultimate safety net preventing a large-scale sell-off.
Exactly. And the analysts believe this relentless buying has established a fiercely protected floor right at $4,000 an ounce. The price simply cannot fall through that concrete foundation.
Okay, so let's synthesize this. We've got the $4,330 tug of war. We have the oil seesaw effect. And central banks are holding the line at $4,000. What does this mean for the listener's actual investment strategy moving forward?
Well, the forecasts are split into two horizons, short-term and long-term.
Yeah, right. And in the short term, the consensus is this tug of war will continue. If the U.S.-Iran deal happens, expect a slow climb with short corrections.
But the long-term horizon is where the data gets fascinating. The analysts predict that once the FED finally signals rate cuts, gold will break out and aim for a target of $6,000 or more.
$6,000? Wow. But getting there isn't going to be a straight line. The sources strongly caution against chasing these hot upward trends right now.
Do not panic buy if gold spikes $30 in an hour.
Yeah, you have to look at the broader FAD context. The strategy they recommend is dividing your capital into smaller entry points. Scale in slowly. Maintain a balanced portfolio.
You have to preserve your options. And strictly observe the market's reaction after the FAD's policy message is released.
Don't guess the coin flip, wait to see where it lands.
Exactly, because the current low volatility is incredibly deceptive. It's a tightly wound spring. When it finally breaks out, it's going to move incredibly fast.
So it sounds like the advice isn't to walk away, but to stop betting all your chips on a single hand.
Right.
But I have to ask, psychologically speaking, is it harder for investors to just do nothing and wait compared to jumping into a rising market? Especially with the $6,000 target floating around?
Oh, it goes entirely against our human nature. The fear of missing out, FOMO, is a much stronger emotional driver than the fear of losing capital.
Yeah, you see an asset holding near historic highs, and the instinct is to jump on the train.
Exactly. Sitting on your hands requires immense discipline. But that discipline is what separates the smart money from everyday retail traders. Institutional managers position themselves based on what the FED actually says, not what they might say.
So it takes serious discipline not to jam a wrench in the gears just to see what happens.
It really does.
All right, let's quickly recap the main takeaways for you listening. Gold is stubbornly holding above $4,300. Silver is showing strong industrial resilience at $70. Cooling oil prices are shifting the inflation narrative. But ultimately, the entire global market is just holding its breath for the FED's forward-looking signals.
It can be a complex web, but understanding it transforms you into a prepared investor.
Yeah.
And if we connect everything we've discussed today, it leaves us with one final critical question.
Let's hear it.
We noted that central banks are quietly hoarding gold, building that $4,000 floor. If these sovereign entities are aggressively buying at historic highs, even as oil cools, even as panic subsides, and even while yields are attractive, what long-term structural shifts in the global economy do they see coming that the everyday retail investor is completely missing?
Now, that is a thought that will stick with you. I mean, are they preparing for a massive currency shift, a systemic resurgence of inflation? It really forces you to wonder what the architects of the system see on the horizon.
It certainly does.
Well, thank you so much for joining us on this deep dive. Keep questioning the consensus, keep looking past the headlines, and don't let the market rush you into a false start. Also, please don't forget to like the video, subscribe to the channel, and comment with your thoughts down below. We'll catch you next time.